Yes, I thought we should just start with tick charts today, and what I've actually got set up on this workspace just for a change, and it's a question we get asked. We get asked a lot of questions, but one we do get asked quite regularly is for trading futures, where do you start? Which, if you're trading indices, this is a relatively new contract. This is a micro contract for indices. So the normal contract is either the ES or the YM or the NQ, and this is called the MES, and it works in exactly the same way. The difference is that it is a tenth of the contract size, so it is a much smaller contract. But the principle is identical. The interesting with it is, though, the interesting thing about it is very much when you look at the actual tick activity is relatively low, or is very low, in fact, in terms when you compare with a full size contract. So it's just a nice low risk entry into the world of trading indices. It was introduced last year by the CME. It's available on all the contracts, and they have proved very popular. And as you can see, it is liquid. This is the other problem, generally speaking, with micro contracts. If you trade micro contracts on currency futures, for example, what you find there is they tend to be relatively illiquid, and the price action is not particularly smooth. These are very popular, and therefore the price action is very good. As you can see, it's exactly the same as you would expect on a normal full-size contract. So I'd urge you, if you're looking at trading index futures and you're relatively new to the business and you're not comfortable trading full size of $5, $25, $60, whatever it is for points and ticks, then this is a nice way to get into that business and to get into the market, to turn the water in terms of trading futures using the micro contracts. Let's just hop over onto the full size and see what's going on. It's pretty stagnant at the moment. Drop this out of the way. We have the YM at the top here. And even this is a relatively small contract in terms of you've got the small and the big. This is $5 a point. You've got $25 a point, and then you obviously go in multiples. This is the NQ, and this is the ES over on the right-hand side. Put that back in there. And this is where we are. It's pretty narrow price action, whichever one you care to look at, full size on the daily contract. Pop that up. This is what we're trading in right now. And when you look at the relationship between volume and price on the preceding days, it's no great surprise. Several reasons, in fact. First of all, we have the volatility trigger on the daily, which is unusual, but it occurs. And sometimes even we get them on the weekly. So when you see them on the daily, it is an unusual event, and it's one that should set the alarm bells ringing, because the expectation is, at the very least, some congestion and possibly a reversal. What follows then is no great surprise. We're now trading back inside the spread of the candle, but if we look at the actual volume relationships over the last couple of days, certainly, or last few days at any rate, this was fine. We saw the market move lower. In fact, it opened gapped up from memory, gapped down rather from memory. And as I said at the time in the trading room, gaps get filled. It's a common ploy by the market makers and insiders who would like to trap you. In a way, it's similar to a volatility trap. This trap is simply based on the expectation of a gap being created, and therefore traders jumping in on the expectation of a move, a continuation of that move, and the price action consequently reverses and traps you. And as we say, the old saying is gaps get filled, and it's a trap that you will often see coming out of the weekend. So the markets reopen, and there are gaps all over the place. Now, clearly, you see this in futures, in cash markets. You see it in stocks, not so much in forex. So it's always something to be aware of. As I say, it is a trap. The market fell. A lot of volume came in, lots of buying under that candle, nice deep wick to the underside, and it closed, as you can see, the gap being filled, and we closed back considerably higher than the gap down open on excellent volume. The following day, we then had a anomaly, clear anomaly, because we've got increased volume, not by much, You could argue it's the same, but effectively it's slightly more. But in terms of the price action, it's narrow. So you've got a ton of volume going into a relatively confined space, in other words, narrow price spread. You've also got a wick to the upper body, so it's hardly a sign of strength. There is a decent amount of selling in here, certainly reflected off this candle here, into this candle here. So you've got selling, you've got a compression of price, you've got selling pressure into a weak market, a market that is still extremely nervous, fragile for whatever reason, 26 different reasons, but take your pick. So that's the analysis from a technical perspective, and that's where you look at the volume, the price action. You look at previous volume and price action. You can compare it with others. You look back over the chart. You maybe look at some of these other price spreads here. You're looking at this one. You think, well, okay, let's try and go and find one that's got a similar price spread, for example. Not too many around, but I mean, you could look at this one, for example, and say, well, that's a little bit less. What was the volume like? It was substantially less. That looks in more or less in agreement. This looks in disagreement. When you look at this one as your benchmark candle, and then perhaps you track along and you look at this one, you think, well, is this reasonable? Yeah, it looks fine. Why? Because the spread is wider, but the volume's higher. So in the context of comparing it with this one, you'd look at that and say, yep, that's fine. Price and volume are in agreement. That looks okay. There's no particular disagreement there. The next candle comes along, narrow spread, yep, fine. But then the volume's fallen away. So again, it's not an anomaly. It's purely representative of the fact that the price spread is narrow, but the volume has fallen away. If you had high volume on that candle, then clearly it would be anomalous. So that's what you're looking for the whole time, price agreement, price disagreement. So we've got it here pretty clear on the chart. And now we're into these narrow days of indecision and waiting for whatever may come along from the Fed, whatever may come along from a fundamental perspective, whatever may come along from a global pandemic perspective. And it's just the way it is at the moment. And the only way you can read the chart is with volume, because it tells you, what is going on behind the price action. Pretty much the same on the other two indices. This is the YM on the daily. Pretty much the same picture. Probably not quite so much aggressive buying here, but again, weakness here with this up candle. And going back to what Anna was saying earlier on about the relationships, not only the cross-market, inter-market relationships, but also the relationships between markets within themselves that should be behaving in a similar way. And of course, indices is one. You would expect, all things being equal, to see these three indices behave in a similar way. Now, generally speaking, they do. But again, over the last couple of weeks, we have seen divergence. We have seen days, and I've highlighted again in the room, where we see this, where you see a down day, perhaps, I'm trying to think which way around it was, but there was one day in particular where I think it was the NASDAQ was up, and quite well up, whereas the YM and the ES were down. And first of all, what that's telling you is that there is a great deal of uncertainty in the market. You have to ask yourself why it is that that particular index has risen so strongly, and yet the others are not. You've also got to bear in mind that the indices are constructed in very different ways. The YM is a very narrow index, if you will, in terms of market sentiment. It's very limited in terms of very large companies, obviously, but very limited in the spread. Whereas where you move to the ES, where you've got hundreds of different companies, one could argue that that is a much more balanced view if you're looking at it from a purely fundamental perspective. And if you're looking from a technical and trading perspective, what it also often reveals, and this has happened many, many times, it gives you a heads up as to which way you should be trading. Because if you've got one leading and two lagging, the one that's leading has got to be very, very strong to drag the other two up. And the chances are that the one that's leading is actually going to pull back and not continue higher against the weight of two pulling against it, if you will. It's a tug of war where you've got two against one. So always consider related markets in the sense of within the market. Obviously, within the Forex market, you're looking at currency pairs within that sector, if you will, and you're not looking outside in terms of risk and all the rest of it. So you always bear that in mind. So that's where we are at the moment. It's pretty thin. Another question we get is, and perhaps I could ask a rhetorical question here, is when you get into you jump in your car first thing in the morning. You know, what is the first thing you look at? Now, on your instrument panel, and I would suggest the first thing you look at is your petrol tank gauge, because if you haven't got any petrol, you're not going anywhere. So it's the first instrument you check out. You go, you have a look at it. Have I got enough? Yeah, fine, off we go. It's pretty much the same here. The first thing you should look at in the morning or whenever you start trading is the VIX. A lot of traders seem to think that the VIX is only pertinent to you as a trader or more as an investor. If you're looking at buying stocks, you know, long-term buy and hold, that sort of type of investment, you know, where is the VIX? Is it, you know, is it all-time high? Is it down in the, you know, the sub 10, 9, 8 figures? Where is the VIX, and what is it telling me about volatility, and what is it telling me about, you know, the balance of calls and puts? The VIX is an intraday instrument as much as it is a longer-term investment tool. It's one and the same. And I can't stress it too strongly that when you sit down and open your trading screens, you should have the VIX up somewhere, because it gives you an instant, it is the premier, the king of the heap index for giving you an instant view of sentiment in the market. It's as simple and clear as that. And if you don't have the VIX up somewhere, then, you know, you really are, it's information that is there. It's freely available. If you don't have it, like, you know, I've got it here on TradingView, but if you don't have it on TradingView, if you don't have it on your system, you can find it over at investing.com. There's a chart there, and just, you know, keep it up somewhere and it'll give you a heads up as to what is going on now. And you can see for yourself what is going on right now. We've got the 1 minute here. Sorry, I think I've got that on the 2 minute. Change that back to the 1 minute. Got that on the 1 minute. That's on 1. Apologies as well. Sorry, I was in the wrong window there. That's on 1. Change that to 2. There we go. So we're on 1, 2. This is the 5. Down onto the 10. Down onto the 20 minute and over onto the daily. And this is where we are. It's again just put that up full size. Get one of these up full size. Make it a bit easier. There we go. Let's change that to the day. There we go. What's curious about it still, and we've highlighted this previously from a longer term perspective, from a daily perspective, and what is like to happen next. The VIX is currently trading at 33.2, and given the rally in indices, which has seen them recover pretty much all the losses and more in some cases, it is curious that the VIX maintains this level of 33, which is very high. It's a level that you would normally associate it with quite a spectacular fall. You'll see the VIX spike to 33 or 40 and then recover. So what we're actually witnessing right now is a VIX that is out of balance with the current market sentiment, in our opinion, at any rate, because all things being equal, this should be down here somewhere at these levels over here of January and February at the start of the year. This is where it was oscillating. It's been there for a long, long time, flipping down into single figures. Almost, it went down to 9 at one point. But in terms of a market that is bullish, where risk-on sentiment is very much in the ascendancy, this is where you expect to see the VIX. Given that we've had this huge recovery in terms of indices, the VIX has not returned to these levels. It is still sat here in the mid-30s. And that to us seems anomalous, purely from the perspective of, well, if it does this, it should do that. And if it reverses, it should go there. That's not to say that, you know, that is it is a simplistic view, if you will, but it's certainly something that you should consider in terms of where risk on sentiment is heading next. And it certainly applies when we saw the Aussie yen pairs rampaging higher. It was all out of balance. It was just absurd. It was froth and nonsense, which it proved to be. And again, it was something we highlighted. These are the things that you have to, they are slightly more nuanced, if you will, but they give you a different perspective. And to go back to the point I was making earlier on, whatever you're doing, whatever you're trading, whether you're trading spot forex, whether you're trading currency futures, you should have this up, because it just gives you a straight linear view, if you will, of fear, risk on, risk off, because this gives you the balance of weight of calls and puts, and it just tells you what the market is doing. And what it's telling you loud and clear right now is this market's not going anywhere in terms of risk, because it rallies and it falls, and it's rallying and it's falling, and it's just got no momentum right now. Just going to pause there for a moment. I'm just going to move to another workspace. Bear with me a moment.